It says intro to level 2. Level 2 just basically means the most basic level of options trading that you are allowed to do by brokerages, like really any brokerage, really. So they usually allow you to only do 4 things when you first get into trading options, and that's just because you're inexperienced. They want to make sure that you understand how they work. And so this is what we call single leg option strategies, which means that you can either only buy a call or buy a put, or sell a covered call or sell a cash covered put. And so you can't do complex strategies, right? Because you're only able to do one thing at a time. What you can do in the future with complex options trading strategies is you can combine these 4 options to do more complex things. And we'll talk about those in the future lessons. But today is wrong date. Today is May 11th, 2020, Monday. Feel free to ask questions as usual anytime during the lesson, and I will answer them when I get a chance to see them and answer them. It should be a pretty options are complicated. There's no really simple way to put it. Options are complicated, so I'm going to try to make it as simple as possible. But once you understand options fundamentally, then you can do some really, really cool stuff. In my opinion, as a trader, if you are only buying or selling stocks, you're really handicapping yourself, because with only buying or selling stocks, you're only doing very, very basic strategies. You can only bet whether or not the stock will go up or bet that the stock will go down. But with options trading, what you're able to do is you can still do betting if it's going up or down, but you can also do it with less money, so you can have lower risk and a higher reward. Or what you can also do is be non-directional, and which is very powerful. What you can do is you can just hope that the stock stays within a certain price and you still make money, which you can't do with just buying or selling stocks, right? So here's the table of contents. Intro to level 2. Why am I teaching it already? How do the options work? Difference between leverage and margin, stock versus options, pros and cons. Then I'm going to go through the 4 strategies: naked long call, naked long put, covered short call, and covered short put. Again, it's really important that you understand what long and short means. Long means to buy something. Short means to sell something, okay? So when you short a stock, what you do is you sell it first, and then you buy it back at hopefully a cheaper price, right? And that's how you make money. In shorting a call or a put, a similar concept, actually exactly the same concept. You short a call or short a put, so you're shorting at a price and you're hoping to buy it back, that call or put, at a cheaper price in the future. And then we'll talk about a little bit about risk management for options. Obviously, this is the first lesson. There's so much I want to talk about. We're not going to go through everything I want to talk about in options in one lesson. But this is just just scratching the surface, because this is single leg, and really what you really want to do is do multi-leg option strategies. Now, ask questions as we go along. It's going to be hopefully simple to understand, but it's a very complicated subject, so I'll try to explain it as best as I can. But remember, you can always ask questions in the comments, and then I will answer them when there. So. Okay, so the beginning is intro to level 2 options trading. We're not going to cover everything about options. There's so much about options. There's the Greeks and how the Greek works, how pricing works in a very complicated manner. We're only going to talk about options in this lesson in a very, 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 very high level, and in a way that is the safest for risk management and the way you should consider trading options, right? This is going to be placing a very strong focus on a break-even point, because that is the best and safest way to trade options. Yes, you can buy and sell options and ride the price movement up and ride the price movement down and make money that way. But it's very risky when you don't actually understand what is causing the options price to go up or down and how fast it goes up or down. And there's a lot of complexity to that. So please keep that in mind. I'm going to teach it, at least in the first lesson, in the most basic way possible, so that you are trading options in the safest way possible. And so you don't lose a lot of money, because you can. It is very risky. Options trading has a ton of complexity to it. The Greeks, like I said, multi-leg strategies. You can only do single leg strategies when you first start options trading in any brokerage. You have to apply for level 2, and then you have to apply for level 3 in order to do multi-leg strategies. So yeah, so there's a lot of complexity to it that influences day-to-day pricing, but we will hold off on teaching those concepts until a later lesson because I want to teach good option trading habits before teaching things that will only overcomplicate options trading. And to be honest, like, yes, I understand the concept, and yes, you can make money on the price movements, but whenever I enter an options position, I am always thinking about the break-even point because that is where you actually are going to make money. Okay, you can be lucky and ride uptrends or downtrends, but at the end of the day, when you understand what I mean by break-even point, from that point is when you make money, and you have to keep that in mind. The overcomplication can create bad trading habits, which I want to avoid for you guys. Remember, everything said in my videos is my opinion and based on my trading experience, and is for educational purposes only. Trading is very risky, especially options trading. Nothing I say is a recommendation or advice. Please read the description and trade at your own risk. Now, why am I teaching options already? Can you trade options with a small account? Yes, you can with even $100 because the beautiful thing about options, which we'll touch on later, is that it gives you leverage. But I do not recommend doing this until you understand options very well because options are extremely risky inherently. And if you only have a small amount of capital, then you're forced to buy riskier options. Now, you probably don't understand why you have to buy riskier options right now when you have a little bit of money, which I'll explain later. But when you don't have a lot of money, you're only able to buy options with a very low chance of success, unfortunately. So what you can do, though, is you can use it to play breaking news, probably, which I will talk about, I think. Why am I teaching it now and this early? One is options trading is what I'm truly passionate about. Like I said, because of the insane amount of methods and tools it adds to your trading tool belt. If you're trading without truly understanding options and also trading options, in my opinion, you're basically trading somewhat handicapped because you're only able to long or short a stock, right? You can only hope it goes up or hope it goes down, versus you can do so much different strategies when you actually have multi-leg options trading in your tool belt. Now, that's actually what I said. Instead of being able to only go long or short, with options, you're able to add a ton of new methods. We will slowly touch on these. I will continue to remind you of these methods of options trading as we go on, just like I did the 8 strategies that I talked about in lesson 4. As we add more strategies and option strategies, I will continue to remind you of them so that you guys can use them in your own trading. You can utilize options during very specific scenarios, such as breaking news, to trade highly priced stocks with significantly less capital. And this is when I would use options trading with a small account, and it's because it provides leverage, which we will discuss later. It also allows you to bet in the bearish direction, which is hope that stock goes down by buying puts. Like I said before, you can't short a stock unless you have $2,000 in your Webull account. And if you own Robinhood, guess what? You can't short a stock at all in general. So it actually blows my mind that that's the case. But that is the case. And so what we do to work around that is buy puts. And you don't need $2,000 to buy puts. I don't believe. I actually never tried that yet, so I'll let you know. But you can buy puts, which allows you to work around shorting stocks with a small account. This also allows myself to add this options trading method to my $100 trading challenge so I can bring it up on the weekly recaps, and so you guys can learn how I use them during my small account challenge. Now, remember, you're a beginner. It is normal to not be good at trading or consistently profitable yet, which is why you should paper trade, especially when learning new strategies or using new tools like options. But hopefully my lessons will help shorten your curve. Now, let's do a really quick and dirty explanation on how options work. And so if you guys have any questions, like I said, feel free to ask them in my chat or in the comments below, but I will continue to go through. So what is an option? An option, I've heard it explained many ways, but I actually recently thought of a way to explain it very well. An option is actually a one-directional promise. So as a buyer of an option, if you buy a call or buy a put, you are buying someone else's promise. So if you are buying a call, you're buying someone else's promise to buy that stock sell you that stock at that price. So if I said I want to buy, let's go with the SPY here, the S&P 500, and the current price is at 293. Let's pretend I want to buy a call. And I say I want to buy a 293 call, which means I want to buy someone else to promise me to sell me the S&P 500 at $293. Okay, and if I'm selling a call, then I'm selling my promise to someone to sell them a $293 SPY stock. Basically, that's what it means. So, and when you're buying a call, you don't actually have to use that promise, right? It's an option for the buyer. You don't have to, if it's, let's say the price in the future is $290 instead of $293, then you wouldn't use that promise anyways, right? I can just go to the stock market and buy the stock for $290 instead of using the promise that I bought from someone at the $293 price. So that's pointless. And basically what happens to your call option at that point is it expires worthless, right? Because the stock price is lower than the promise price that you got from somebody else. And when you're selling a call, when you're selling this promise, that is your dream scenario. You want the option that you sell to expire worthless, so you don't actually come into a really disadvantaged deal, right? You're essentially selling a coupon, right? To sell someone a stock at this promise price, and that promise price is called a strike price. Now, we've talked about it on the call side. What is a put then? A put, when I buy a put, then I'm buying someone else's promise to buy the stock from me at a certain price. So let's say the stock is currently trading at 293.74 as it says on the slide, and I buy a 294 put. That means I just went out to someone and someone sold me their promise to buy the stock at $294. And so if the stock is currently at 293, I can, as a put buyer, I can go to the stock market, buy it at 293, and sell it to this guy that promised to buy it at me at the strike price of 294 and make $1 on that contract. Hopefully that makes sense. So as a buyer of options, whether a call or a put, you're buying someone else's promise. When you're buying a call, you're buying someone's promise to sell you a stock at a certain price. When you're buying a put, you're buying someone's promise to buy from you at a certain price. And then when you're selling a call, you're promising someone to sell them at a certain price, which is a strike price. If you're selling a put, you're promising someone to buy their stock at a promised price, which is a strike price. So when you buy a put, since someone is buying a promise to buy from you, you want the price to go down, right? But if you're buying a call, since you get a promise from someone to sell you the stock at a certain price, you want the stock to go up. Because then as the stock goes up, your promised price becomes better and better because it's below the current stock price. And you can buy the promise, use your promise that you bought at the 293, and if it's at 300, then you just bought it at 293 and the current stock price is at 300 and you just made $7. And the opposite is true for puts. Okay, so that is strike price. And hopefully you understand buying a call, buying a put, selling a call, and selling a put. Those 4 concepts now, and strike price. So 5 concepts. Now, expiration. This should be pretty self-explanatory. So all options contracts have an expiration date. The more time that you have for the stock price, the better for the buyer. As a option seller, you want the option to expire worthless, and the less time for the stock to move around, the better for you. But as an options buyer, the more time, because the market is generally volatile, that you have, then the better for you, because you have more time for your call option or put option to get in the money. And that's what it means by in the money. When you buy a call, if the current stock price is above your strike price, you're in the money. If it's below your strike price, it is out of the money and your call option will expire worthless. Even if it's at the money, your call option actually expires worthless. Why? Because why would you use the promise to buy at a promised price when you can just buy it from the stock market for the same price? So that's why it expires worthless. If you buy a put, you want the stock price to be below your promised price, because then you can buy it from the stock market and sell it at the higher price, and that's in the money for buying a put. If your stock price is above your promised price, well, then you're out of the money, because you wouldn't buy for more expensive and sell it for cheaper. You would be losing money. And so that's out of the money. Okay, hopefully that makes sense. So at expiration, self-explanatory, that is the amount of time you have to use your promise. Okay, and then we'll talk about why, like, oh, well, let's say the stock price currently is higher than your call strike price. You're like, great, why don't I just use my promise right now? Why don't I force that guy to sell me the stock at a cheaper price? And the reason why is the pricing components. There's an extrinsic value to every option, and you don't want to waste the extrinsic value. And we'll talk about that in a little bit after we go through volume and open interest. So volume is the number of trades that occur during that day, okay? And then the open interest is the outstanding and existing positions that were before that day. And they're the amount of contracts that are still existing in the marketplace. So you'll see right here, this says 7,000 basically volume, $1,500 open interest. Let me make sure my volume's on. Okay, good. So that means that day, 7,000 trades occurred, and before that day, there were 1,500 open positions. Hopefully that makes sense. You want, because, stocks and options are different, right? Stocks, there's only one stock. Well, whatever. There's a lot of stocks, but for each stock, there's millions of options contracts. And so you want to make sure that the open interest number is really high. That means it's very liquid, and that means there's a lot of people that hold this contract. If there are like only 2 people that have bought this contract, then when you want to buy or sell that specific contract, it's going to be very hard, right? Because there's not a lot of people that have it. And so there's not a lot of people to buy or sell from for that contract. So you want volume and open interest to be as high as possible. The minimum I look for is 100 of open interest. Don't trade any contracts with less than 100, basically. All right, so let's go through the 3 pricing components for premium. So what I said was in the money, right? That is an intrinsic value. So let's, for example, say that you bought a call at 293 strike price. You bought the promise to get the stock from somebody else at 293, and the current price of the stock is 295. Well, then the intrinsic value is the difference between how much in the money you are. And since the current stock price is 293 and you can buy it from someone else for 293, this current intrinsic value is $2. Hopefully that makes sense. And then the extrinsic value, which is why you almost never exercise or use options, are made up of 2 components. Number 1 is the implied volatility, because of the craziness that has been happening in the marketplace, and why I tell people do not buy and sell buy options actually right now, or be very careful, is because volatility is extremely high right now, which means that all options, buying options, whether it's a call or a put, is very expensive. And so generally in these situations, you probably want to lean towards selling options, but not always. It really depends on finding a good deal. And that's a beautiful thing about options trading. In stocks, yeah, like finding a good deal is basically like, oh, I really hope that the stock goes to like a certain point so that I can enter, and it's kind of a good deal because I think it's going to go up, but it's going to go up from a very low point. But in options trading, you can actually go look for good deals, because these are every single one of these contracts, and each stock has like hundreds of different contracts, and these are traded by real people. The options prices fluctuates, and sometimes they're mispriced, and then you can capture on that and really take advantage of that. And that's why options trading is so beautiful. And I actually did that, and actually was a major contributor to, and when I showed you in my first lesson, how I doubled my account in like 2 months. I found a really good deal, multi-legged option strategy, bought a bunch of them, and then it played out very well. And so number 1 component of intrinsic value is volatility. Number 2 is days to expiration. So the more time you have, because it's more risky for someone to sell you their promise, they have to somehow benefit from that, or take advantage of that, and so they sell you the option for a more expensive price. And so like this one is May 13th. That's going to expire in like 2 days. I took this picture, I forget when, but like probably last week. That's not a lot of time. And so you'll see, let me just show you live examples. Robinhood. Okay. SPY. So let's go trade the SPY options. So if you look at the SPY, oh wow, look at that. And so look, if you compare these prices here, this price 295 to 228, because volatility has increased, it must have, because the stock price has dropped. Then because volatility has increased, let me how do I show you the price components so you can see it at the same time? And this may be a little bit longer of a lesson because it's a pretty complicated subject. But look, because as price comes down, usually volatility increases. Because volatility has increased, the prices of the options has increased as well. And that should make sense. So even though this was taken actually earlier than this has more time to less time to expiration, which should make it cheaper. Because of volatility increasing, these contracts are actually more expensive. And now if I go to farther out, let's say June 1st, and you look at the options price, these are 3 to 4 times more expensive because you have more time to expiration. And it's more risky to sell you this promise as an option seller. And so how do I basically negate that fact is by making the options more expensive, right? Because I don't know how much the stock price will move, and if you have more time for the stock price to move, then I should just make it more expensive so that I hopefully don't lose money to you, right? Obviously, as a buyer, you're trying to make money, and as a seller, you're trying to make money. And so both sides have their own interests at heart. And so this is what I'm talking about, right? So if you have intrinsic value, let's say 295 to 293, that's $2 of intrinsic value. But you still have extrinsic value as well. Oh shoot, let me just do a live example here. Great. Okay. So let's stop it. All right, so this is pretty close to 292, which is beautiful. And so the current price is 292. Let's go out to June 1st and let's go to 290 call option. So how much money is this in the money? Hopefully you guys can answer that in the chat. But I'm going to keep moving on without waiting. So this 290 call option is at $7.73 per share. Every contract is 100 shares default. So you have to multiply this price by 100 to get the actual contract price. But this is $7.73 per share. So to buy this options call option contract, it's actually $773. It's really simple. Just move the decimal, get rid of the decimal, and that's your price. Very simple. If this was $17.73, it'd be $1,773. But let's just say it's $292 to make it easy. Then how much intrinsic value does this contract have? It would be $2, right? So if you have $2 and you know the option price right here, you can do the math to find the extrinsic value. So the extrinsic value is 7.73 minus $2 per share, and that is $5.73. And I'm just gonna do it. 7.73 minus the $2 of intrinsic value from the 290 call contract, because its current price is 292. So if someone promised me to sell the shares at 290 and I can sell the shares I buy for 292 on the open market, then there is $2 of intrinsic value. And that means there's $5.73 of extrinsic value, which makes up volatility and X days to expiration. Now, obviously you can see, from 2 days here and you look at the 290, that is about $1. $3.65 minus the $2 of intrinsic value. This has $1.65 of extrinsic value. Awesome. Hopefully that all made sense, and I'll keep going from here. And so this is made up of two things: implied volatility and days to expiration. The longer days you have, or the more time you have, the more expensive the contract. All right, so let's talk about the difference between leverage and margin. So although interconnected, because both in a way involve borrowing money, leverage and margin are not the same. And the very complicated thing is that in finance, leverage is used in many ways, unfortunately. You gotta love English. But that is the case. So leverage refers to taking on or taking advantage of debt, while margin is debt or borrowed money a firm uses to invest in other financial instruments. So we take advantage of leverage when trading options, Now, I strongly recommend do not use margin for trading or investing. Don't invest with money you can't afford to lose, and borrowing money to invest is a way to lose a lot of money because you have to pay people back. So when you trade on or using margin, you are actually borrowing money from your brokerage to invest in things like stocks or even options, which is crazy that people actually are allowed to trade options on margin just because it's so dangerous. But think of it as like paying a down payment on a stock when you buy that you want to buy. So and you ask your brokerage for the rest of the money. So if you want to buy a $115 stock, you can actually like pay $15 and borrow from your brokerage $100, and that is trading on margin. Very dangerous, because what if the stock, let's say, goes to zero? Well, not only do you lose the $15, but you also have to pay back your brokerage $100 plus interest. But when you take advantage of leverage, when you're using trading options, this is very different. The difference when taking advantage of leverage while trading options is when you buy an option, you're technically paying a smaller percentage of what the stock price is. Therefore, when the stock price moves a little, your option moves a ton. However, you are not borrowing any money or margin or using margin from anybody to buy the option. So why are you getting a benefit of leverage when you buy options? Because you're only buying a promise, right? You're only buying a promise. So if you buy a promise from somebody, let's use that same example from Les right here. I pay him $239 for a promise for him to buy a call option. So someone sold me the promise that he will sell me 100 shares at $293. Well, it's only a promise. If I want to use the promise, I still have to actually go buy 100 shares at the strike price, which was 293 times 100. So even though I paid him $239 for the promise, if I ever want to use the promise, I actually have to pay him, and I know the math, but I'm just going to do it for you guys, times 100, $29,300. Oops. $29,300 to use the promise. Now, do you understand? So you get the benefit of leverage because you actually don't have to pay them, and you can buy and sell an option whenever, and you almost never actually use the promise. But when you're thinking about trading options, you want to think of it as if you were going to use the promise, because that is the safest way to trade options. Okay, so basically, I paid this guy $239 right here. To say, hey, I want you to promise me to sell this stock for $293 per share and 100 of them. Options contracts are always 100 shares. And so if this goes up to, let's say, 300, then I get the benefit from between the strike price and the actual stock price. So that's $7 times 100, right? So 7 times 100. Right? So I get the benefit of $700 of profit, but I paid for the promise at the beginning. And so this is how you calculate the profit. You have to remove the price that you paid for the promise in the beginning. And so if the strike price is $293 and the current stock price is $300, then you actually only make $461. But think about that. You made $461 on $239. That's almost a 200% return. And if you bought 293 and let's say you bought divided by 230, sorry, excuse my language, 300 divided by 239, 293, shoot, 300 divided by 293, if you bought 100 shares at 293 and it went up to 300, you only made 2%. That's 200% versus 2%, and that is the power of leverage, and that is the power of options. By buying this promise and not actually buying the shares, because you never actually have to use it to buy the shares, you are able to take advantage of leverage. Now, where it gets a little bit complicated, unfortunately, is because, this company is very leveraged. And that people say that in the finance industry a lot. And when they say this company is very leveraged, it means that they have a lot of debt, right? They actually went and borrowed money. But when you're saying, I'm taking advantage of leverage when you buy options, you're not actually taking on any debt at all. You're not borrowing even $1. No. What you're doing is you're buying a promise that acts as 100 shares. And since it acts like 100 shares, because you have the promise, you are able to take advantage of leverage, but you are not borrowing money at all. Can you use margin to buy options contracts? Yes, but do not do this. Yes, this would mean you are borrowing money to buy something that is leveraged. So think about that. It's extremely dangerous. Do not do this. I already think you shouldn't even use margin when you just trade stocks. So do not use it when you trade options. Okay, so let's go through the pros and cons of stocks versus options. So with the stock, what do you get? You get unlimited time. They don't expire, right? So it's much less risky than options. Also, stocks rarely go to zero, while a large percentage of options expire worthless. Why? Because when you buy an option, you have to be right? You have to have the stock price be in the money versus your strike price. Otherwise, your option is worthless. And so that is very risky and very dangerous. And that is why trading options can be very dangerous. But what's the benefit of options? Options allow traders to trade at a high price stock or even a low price stock at a fraction of the current price, right? And that is the benefit of leverage. And buying puts is safer than shorting a stock, because when you short a stock, the price that the stock can go to up is infinite. And so you can lose potentially infinite risk. But when you buy a put, you can only lose the money that you bought the promise with. And that is the beautiful thing. And so limited risk versus unlimited risk. So in certain scenarios, shorting stocks specifically, shorting stocks is riskier than buying a put, but just only in that scenario. But puts have expiration dates and stocks don't. And so that's the risk versus reward balance that you have to do. There's a ton. Another benefit for options is that there are so many more strategies available than just buying or selling a stock. And we will be slowly going through all of them. In this lesson, you're only going to be going through the 4 most basic ones, which is a single leg, buying a call, buying a put, selling a call, or selling a put. In the future, we're going to do crazy combinations of these to make very complex strategies. But these are the building blocks of options trading. So you have to know them, and you have to know them very, very well and be very comfortable with them so that we can start doing complex strategies with them. Hopefully you can start already getting ideas popping in your head with how to use these things, how to take advantage of strike price, how to take advantage of expiration, and things of that nature. But if not, don't worry. We're going to touch on these in future lessons. Now, what is the con of stocks? Well, with less risk comes less reward, right? So unfortunately, like I said earlier, if you bought a $293 stock and it went up to $300, guess what? You only made 2%. But if you bought the $293 call contract and it went up to $300, then you made 200% on your money. And so that is the benefit of options trading. Again, you can only long or short stocks, which makes it very limited strategy-wise for what you can do with stocks. But what is the downside of options? If the stock price does not beat your strike price and it's not significantly in the money, it doesn't just have to be in the money. You have to beat your break-even point because you paid a price at the beginning to get a promise at a certain price, right? Remember when I said $293, but you paid $2.39 for that contract? So really, to break even, the stock price has to be more than $2.39 in the money in order for you to break even. And we'll talk about why that is the case, but hopefully that already makes sense. If the stock price did not beat your strike price significantly, then you lose 100% of your investment. It's much higher risk than stock. Must be right before your option expires. Again, limited time frame, which also adds to the risk. Long naked options, whether you buy a put or a call, are depreciating assets, because remember when I said, as you get less and less days to expiration, or if volatility comes down, your options contract decreases in value, right? That affects the option price. So this is why it's not so simple as stock. Stock prices go up and down just based on the stock's performance. But options contracts, they will go down every day based on your losing your days to expiration and if volatility goes down. And that's why it's very dangerous. But they are also very powerful because you get the benefit of leverage. Options contract the con is unlimited risk when you're shorting naked options. Now, if I'm buying a put, when you're buying a call or buying a put, you only can risk the amount of capital you use to buy it. But if I'm shorting a call or shorting a put, which we'll talk about later, you have unlimited risk because you are promising someone a specific strike price, which is that promise price, And so depends on how the stock moves, you technically have unlimited risk, right? Because you already promised someone at a very specific price to buy or sell stocks to them. Now, again, what depends is how you take advantage of the leverage. It can be a weapon for good, or it can be a weapon to destroy your portfolio. So make sure that you're using it the right way. Okay. All right, so let's talk about naked long calls. Hopefully at this point you already have a somewhat good idea of how it works, but let's go through an example. If I buy, when you buy a long call, you are buying someone else's promise to sell you a stock at a certain price, right? So I'm going to use example. We have 4 people here. Hopefully you guys are able to do this pretty quickly. So let's say, I'm going to use a pen. Let's say that I bought the current stock price. Stock is at 90, and that the call option that you bought is 88, right? How much intrinsic value do you have at this point? Let's see if you guys are able to answer that. As you do that, I'll add to this problem. And let's say you bought this at a premium of $3. Okay, so the current stock price. So this is the call option. Let's ignore this. You long the call at 88. The current stock price is at 90. And then what is your break-even point? So one is how much intrinsic value does this have right now? And then what is your break-even point? Let's see if you guys are able to do that. I'll give you guys a few minutes. Anyone can tell me the intrinsic value and what value you break even at? Nobody? Okay. No worries. I will just walk through it. So your intrinsic value is the difference between the promised price that you were able to, since you bought it, buy the stock at, because someone sold you a promise to sell you stocks at $88. So the intrinsic value is $2. And because after it passes your strike price, you make money times 100 for every dollar it passes. So at $89, you make $100. At $90, you make $200, right? Times 100 equals $200, right? But you paid $3 per share at the beginning to get this promise. And so that is $300 before you break even. And so you need, in order to calculate the break-even price, is simply how much did you pay per share plus the strike price. And so what is 88 plus 30? 88 plus 3. 88 plus 3 is 91. And so the break-even price here is 91. And so you'll see at the strike price, you start making money, but you still have to make up the difference for how much you paid for the stock price or the call contract. And then after that, 92, 93, you make $100 every dollar that it goes up. And you have unlimited profit potential as a person that buys a call contract, and as a person that sells a call contract, you have unlimited risk. Hopefully that makes sense, because the stock price can go as high as it wants. That is a naked long contract. Okay, so let's do a naked put contract. Hopefully that was a little bit more easier to understand. Let's do it the opposite way now. let's say you bought a put at $92 and the current stock price is again at $90. And again, you paid $3 for this promise from this put contract. And you can see it here. When you buy a put, you buy the right to sell 100 shares at a certain price. And when you short a put, you promise to buy shares at a specific strike price. So someone promised to buy the stock at $92. What is the intrinsic value of this contract currently? And then what is the break-even point? Give you guys a few minutes here. So you bought a promise and someone sold you a promise. Someone sold a promise to buy the stock and you got a promise to sell the stock at a certain price. Okay. So this is very similar to a naked long contract, except it's the other way around. And so 92 minus 90 is $2 of intrinsic value because you're able to sell it at $92 and the current stock price is $90. So you make $2. But and that means you've made 200 and that's 90 right here. And let's ignore this and say you bought it at 88. And so, but 92. Shoot. 92. Right? And then, so the break-even point is actually 92 minus 3, which equals to 89. Right? 92 minus 3 is 89. Right. And so the break-even point here is 89. And so after it goes lower and lower, you make $100 for every dollar it goes below. And so if this was like 85, then you would make $400 of profit, right? But you have to make up the difference of paying for that promise, basically. Wait, put 92. Current stock price is at 90. Oh, it should be like this, actually. Unfortunately, it's not a perfect graph because obviously I've got these from Tasty Trade. If you don't understand any of these concepts, I highly recommend you go watch Tasty Trade's course on their website. It's 100% free. This is where I got these images from. Like I said, right here, source. All their options, introduction to options contract, options trading course is 100% free. Go to the Tasty Trade website, 100% recommend it. And if you don't understand any of these concepts, then please go watch their videos. Now, like I said earlier, if you are selling a call contract or selling a put contract, then technically you have unlimited risk. But there's a way to protect yourself against the risk if you are sorting them. And that is by covering your call contract or covering your short put contract by basically doing what you're promising to do already right up front. Right? So if you're shorting a call, you're promising to sell someone 100 shares at a specific price. How do you protect yourself from unlimited risk? Well, then you just have to own 100 shares of that stock already. And when you're a level 2 options trader, to protect the brokerage from you not making crazy bad options trades, they force you to cover your call contract or cover your short put contract. And so what it does is instead, if let's say you sold someone a promise, short call, that you said, I promise to buy your stocks for $100, right? And the current cost of the stock is $90. Okay, well, you don't have to buy. He's not going to use it unless the stock price goes above the strike price, right? Because why would he buy 100 shares at $100 from you if they can just buy it from the stock market for $90. That doesn't really make sense. But if it does go above 100, then you're screwed, right? Because you technically have to sell him the stock for $100, and let's say if it's $2,000, well, you have to go buy 100 shares at $2,000 and sell it to this random guy at $100, and you'd lose $1,900 per share. What you could do is, as the stock price is wherever it is currently, you can go and buy 100 shares, and then no matter what price it goes to, you already own 100 shares, and you can just give him the 100 shares that you promised him because you already have 100 shares. That is a covered short call, because you shorted a call, you sold him a promise right here to sell him 100 shares at a specific price, and you specifically promised him 100 shares because each contract is 100 shares, and you already have 100 shares, so you just give him your shares. Very simple, and that's how you protect yourself and protect the brokerage. Okay, and then the next one is a cash covered short put. What do you promise when you sell a short put? When you sell a put, but it's shorting a put, right? When you short a put, you promise to buy 100 shares at a specific price. So let's say the current stock price is at like let's just say 95. Oh shoot, what the heck happened? Let's say the stock price is at 95, and you promised to buy it at let's just do 92. Well, if you were on the option in the stock market, you can always sell it shares to the stock market, right? It's called shorting a stock. So what he wouldn't short, the person that's buying a put option isn't going to sell to you at $92 if he could just sell it to the open stock market at $95. But if it goes below that, let's say it goes to $80, then he'd rather sell it to you at $92 than sell it in the stock market at $80. But how do you protect yourself against this? You promise to buy shares at $92, and you promise to buy 100 shares at $92. So all you have to do is make sure you have the money to buy 100 shares at $92 in your account at all times. And this is called a cash covered short put. As long as you have $9,200 in your account, it doesn't matter what price the stock goes to, because you're always going to promise to buy it at $92, and you're promising to buy 100 shares. So you just have to have $9,200 in your account at all times, so you're able to fulfill your promise if he ever forces you to fulfill that promise. That is a cash covered short put. Okay, so let's go summarize the 4 ways that you can buy or sell options. You can long a call, or you can long a put. You can short a call, or you can short a put. How do you make money when you short a call? When you sell a call or sell a promise, you want the stock price to go down or hit the stock price that you promised to sell the stock at. If you're buying a call or buying a promised price, then you want the stock price to go as high as possible, because you already bought this coupon promise to buy a stock at a specific price. And so if the stock skyrockets, you still can always buy the stock at a really low price. What about a short option or a long option, a long put? So if you're shorting a put or selling a promise to buy shares, you want the stock price to go up so that you don't have to buy the shares, right? Because he's going to sell it in the open market, or hit the price that you promised to buy the stock at. If you are a buyer of a put option or a longer of a put option, you want the stock price to go down as possible, because you just bought someone else's promise to buy the stock price at a certain price. And if the stock price is currently really low, let's say $1, and I could sell it to someone at $90, then you make a lot of money, right? Because I can buy 100 shares at $1 and sell it to this guy that promised me to buy it at $90. The circle right here means who makes money. There's more ways to make money when you sell options, and that is why generally it is considered, actually, funny enough, on Wall Street, safer. And this is what most Wall Street firms do. They sell options. But I just said selling options has unlimited risk. Yes, it does, technically. And so if you do it correctly by selling a very, very out of the money option, right? Let's say the current stock price is $10, and I sell a call option for $1,000. Well, that is very out of the money, right? The price has to go above $1,000 just so that I have to use my fulfill my promise. And so that is what a lot of Wall Street people do. They sell very out of the money call or put options, and they seem very safe, but obviously you never can predict the stock market, like the coronavirus dropping the stock market at 35% in 2 weeks. A lot of firms in the Wall Street got destroyed by this, right? And that's why you have to be very careful when you short options, and that's why brokerages in level 2 options trading force you to cover your shorts by either owning stocks or holding the amount of money that you promised you need to fulfill your promise when you short puts. Okay, but there's other ways to get around this, and that is doing multi-leg option strategies, and that will be in the next lesson when I start going over credit and debit spreads. But you really have to have a really strong understanding of this concept, of these 4 ways of trading options, before I can move in that direction. And so please, if you do not understand anything in this video, please leave a comment below and I will be happy to answer them, or go through the free course on Tasty Trade's website that talks about trading options. And it actually goes through all the strategies of trading options, not all, but a lot of them. And so once you have a strong understanding of those, we can start having a lot of fun and actually taking advantage of these strategies and trading the stock market with them. Longing calls and puts have limited downside risk and unlimited upside, but they have a lower probability of success because you have to buy something and you have to be right? The stock has to move in the direction you want it to. But shorting call and puts have limited upside but and unlimited downside, but they have a higher chance of success because if you short a certain price, as long as it doesn't reach your strike price, you're good. Okay, so risk management for options trading. Note, risk management for options trading is very different than risk management for stocks trading. So please be very careful when you trade options. The easiest way to control your risk when you're trading options is just keep your position when you're buying an option to 2% of your total capital, because then the most options expire worthless. If you buy a call or a put with 2% of your capital, then you only risk 2% of your total account, and that's beautiful, right? Remember, 1 to 2% is all you ever want to risk in each trade. The importance of timing your trade as well as possible to give you the best chance of success. So remember the strategies that we talked about in swing trading. The swing trading strategies tell you how to find good opportunities to enter a trade. And so you take advantage of that information, take advantage of that knowledge to position your options trade as well as possible. Number 3, always buy more time on options so that even if you're wrong about the stock move, let's say you're trying to play a certain fundamental news, I would not recommend buying options for earnings because of IV crush. And volatility obviously goes up as earnings comes closer, right? Which makes options more expensive. The day after, the second after options, the earnings comes out, guess what happens to volatility? It shoots down. This is a concept called IV crush. And so when you play options, try not to play them during earnings. It's very dangerous. But what else you want to do is buy, if you do play it during earnings or whatever news you play, make sure you buy like one more week or one more month, and so you have more time to be right, or at least you don't lose all your money the second you were wrong, right? Because once your option expires worthless, it expires at $0. But if you buy a little bit more time, then your option doesn't expire worthless because you have more time still. And so options are always worth something as long as there's still more time to expiration. Okay, usually, if it's really out of the money, then options do actually become worthless. So you have to be very careful. If possible, try and make your plays free. Plays free when your profit hits 100% by selling half of your position and letting the rest of the position ride. And what you can do is you can buy like whatever even number of options you want to, like 6, and then when you make 100% on your option, sell 3 of them, right? If you have 6 $1 options and they double in price, then it's now 12 and you sell half of them. Now the whole position is free. So that is one risk management strategy that you can do in options, which is really cool. You can do that in stock trading, but it's almost impossible to get your stock price to double, right? And so in options, you can make 100% returns pretty crazily. Not easily, but it does happen. Okay, so when you want to swing trade options, You can use at the money options to day trade, which means that delta is very close to 0.5. What is delta? Delta is for every dollar movement in the stock price, it is that amount of movement in the option price. So when you're at the money, because there's a 50% chance it will go up or down, delta is 50 cents. And so if the stock price goes up $1 from the money, then your option price will go up 50 cents. And so if you're buying at the money options, you can just kind of think like, okay, for every dollar that the stock price moves, it will move 50 cents in the options price. And you can do the math from there. Pay very close attention to theta. And let me just show you these on Robinhood so you know them. Please work. Okay. Let me close this. We're almost done, I promise. Thank you for being patient, and thank you for tuning into this lesson, because it's a very important lesson. So pay very close attention to theta. So let's go with here. Because this is expiring soon, theta is going to be really high because there's not a lot of time left. So theta is basically time expiration. Remember how I said days to expiration lowers your stock price every day? Theta tells you how much that option price will go down every day. And so if it says negative 0.48, because theta lowers your option price every day, this is 48 cents or 49 cents every day you lose. And so that's, if you do 49 cents over 3.65, that is 13.4% of your options price that you're losing every day. And that's only because you have 2 days left, right, before this option expires. The more in the money you are, the lower theta is going to be, so keep that in mind. Delta is basically the change in option price based on the price of the stock. We're going to go into the Greeks, which these are called the Greeks, more in detail, again, just to recap it and make sure you truly understand it. But if you guys want to trade options now, I want to make sure I at least touch on these. Delta moves your stock price. For every dollar movement in stock price, delta changes the option price. If it moves up $1, then it will move 68 cents because this is in the money already. The theta is the time decay. For every day that goes on, you lose this much in option price. Vega is implied volatility. Remember I showed you guys implied volatility that you can always look at for any stock. You can analyze. Oh, wait, no, trade. Oh, shoot. Okay. Go to AMC, and you can see the implied volatility. So as percentages of implied volatility moves, then that changes your option price based on Vega. So every 1% increase in implied volatility increases the option price of this contract by 7 cents. Hopefully that makes sense. Okay, pay close attention to delta, theta, and Vega. The math won't be exact when you day trade, but at least you guys will have at least some sort of understanding for this. Important, do not use this strategy for earnings. You will be destroyed by IV crush. Hopefully you understand that by now. Because implied volatility will increase coming closer to earnings, and the day after earnings, implied volatility shoots down. And so you have to be very careful when buying options during that time. Okay, post-lesson actions. Go through and go educate yourself on Tasty Trade. Tasty Trade has a free online course on their website. Go watch Tasty Trade's YouTube videos as well. Very, very, very good. Start with options trading concepts and Mike and his whiteboard series first. Go start a trading account with Thinkorswim or Webull or Robinhood and paper trade, or use $100. Use as little money as possible because trading options is very risky and very complicated. Go prepare a trading plan on an opportunity and comment below, and I can give you feedback, or other students can. Comment below what you want me to cover in future lessons, or if you have any questions from this lesson. I know it's very complicated. Hopefully I can answer any questions you guys have. And then the last one's not required, so do it if you want to. Other questions, hopefully you have a basic understanding of how options work. We will be expanding on options trading from here. So this is the basis, and it only gets more complicated. So please go do your homework, go through the course. If you didn't understand anything in this video, watch it again. Watch the free courses on the Tasty Trade website. Go on YouTube. Tasty Trade also has a YouTube account. Go watch their videos there as well. Please paper trade. Cannot emphasize this enough. Until you are familiar with how options work and are consistently profitable for 1 to 2 months. Not only is the pricing complicated with implied volatility and days to expiration, but then you also have to understand the Greeks, delta, theta, gamma, Vega, Rho. And so Please. They're a very complicated instrument, but once you understand this, we can do some really, really cool stuff by using these 4 options and doing different variations and combinations of them to do complex strategies in the future, which I will talk about in the future lessons. All right, I'm going to stay on for another 5 minutes. Please let me know if you have any questions. And then as always, you can always comment below and I will answer your questions there as well. Any questions for people watching right now? I wonder if you guys can hear the kids screaming outside. It's pretty funny. I really hope I did this topic justice. It is very complicated. It took me a while to understand it. If I didn't, like I said, please go through Tasty Trade's website. They have a free course there, or watch Tasty Trade's free YouTube videos. Don't pay for learning this stuff. Hopefully you guys can hear me. Don't pay for learning this stuff. There's so much free information out there. And I'm also a free resource. So comment below on any of my videos and I'll answer any of your questions that you guys have. All right. Looks like no questions from the 2 viewers that are watching right now. And so I'll end my stream there. Best of luck. May volatility be ever in your favor during this week of trading. And I hope to continue expanding on this options topic in the future. And I'm very excited to teach you guys the crazy amount of possibilities that you have with options. All right. Thank you guys for watching. Peace.